Russia plans to raise daily forex sales in the next month. On Monday, the Russian Ministry of Finance announced that, from June 7 through July 6, it would sell $44.3 million, or 3.6 billion rubles, an increase from the previous month. Foreign currency interventions resumed in January after a hiatus of several months, with Russia selling yuan instead of what it terms unfriendly Western currencies, highlighting the growing importance of China's currency in Moscow's efforts to ensure economic stability amid Western sanctions. The Finance Ministry forecasted that its monthly regular FX sales on the market would amount to 74.6 billion rubles. Reuters polled industry experts, and their consensus was that sales would reach 20 billion rubles. To offset the decline in oil and gas revenues, the ministry had planned to sell 40.4 billion rubles in foreign currency in the previous period, between May 10 and June 6. After sending its armed forces into Ukraine, Russia faced widespread sanctions from the West, including the freezing of roughly $300 billion in foreign exchange reserves, so Russia ceased its forex interventions late last year. Revenues from Russia's vital oil and gas exports have shrunk this year due to Western sanctions, so the government has been conducting forex interventions to make up for shortfalls or build up reserves, respectively. According to the ministry, oil and gas revenue in May was 30.6% lower than expected. It forecast a shortfall of 44 billion rubles in federal energy revenues for the month of June. Russia's budget deficit for January through April totaled nearly $44 billion, 17% higher than the target for all of 2023, putting fiscal pressure on the country as Moscow continues its military offensive in Ukraine. The current exchange rate for the US dollar is 81.2075 rubles. Darya Korzunskaya and Alexander Marrow reported for this article, and Toby Chopra and Sharon Singleton edited it. CNBC reported on Sunday that IMF Managing Director Kristalina Georgieva told the network that the IMF has not seen enough evidence of a lending slowdown to convince the Federal Reserve to change course with its rate hiking cycle. In an interview with CNBC, Georgieva suggested that further rate hikes might be warranted in the absence of a significant slowdown in lending and a resilient U.S. jobs report on Friday. The Fed will have to stay the course, she told CNBC, and perhaps in our view, they may need to do a little bit more, because of rising incomes and persistently low unemployment. She predicted that the unemployment rate in the United States would rise above 4% and reach 4.5%. However, a rise in the unemployment rate to a 7-month high of 3.7% in May suggested that labor market conditions were loosening, despite the fact that job growth had accelerated. You may see responses from our community managers, who will be labeled as Yahoo staff, or staff, reporting by Lavanya Iyer in Bengaluru, editing by Louise Heavens. We disable comments on articles after they've been up for 3 days to ensure the best possible user experience. The discussion threads on Yahoo Finance's conversations page are open indefinitely.